Are you already living in a residence that you inherited? Well, we're going to discuss capital gains tax for a primary inherited residence here in a moment. And although we are going to discuss capital gains on selling a primary inherited residence, if you have just inherited real estate and haven't lived in it and want to know how capital gains will affect you, we will get into that a little later in this session. First, when you sell an asset such as a house for more than you paid for it, the difference between the two is a capital gain. Capital gains taxes are paid when you sell an asset at a profit. Since technically you didn't pay anything for an inherited house, the government had to come up with a way to determine your gain. Fortunately, we still have the tax law that allows you to use the market value of the house on the date of the person's death. Although you didn't really pay anything, it is assumed that you bought the house on the date of death of the owner. The best way to get the market value is to have an appraisal done on the house shortly after the person passes away. If you inherited a house and you have lived in it for at least 2 of the 5 years before the sale of the residence, you can exclude up to $250,000 of the capital gain on the sale. You can exclude up to $500,000 for joint returns. For example, let's say that your grandparents bought a home for $200,000. When the last grandparent passed away, the house was left to you. On the date of death, their house was appraised at $500,000. So now your cost is assumed to be $500,000. If you were to live in the house for 1 year and then sell it for $525,000, you would pay capital gains tax on $25,000. That's a selling price of $525,000 minus appraised value on the date of death of $500,000, which would give you a $25,000 profit. You won't have an exclusion for a primary residence because you only lived in the home for 1 year. So you're left with a $25,000 gain that will be taxed. However, you can reduce your capital gains by subtracting any expenses incurred for home remodeling or restoration or closing costs. So if you replace walls and floors in a home remodeling project to make the home ready for sale, you could use these amounts to reduce your capital gain. Now let's assume that instead of 1 year, that you are single and live in the house for 2 years. Let's also assume that you sell the house for $600,000 after the 2 years. You would not owe capital gains tax on the house because you can exclude up to $250,000 of the gain since you lived there for 2 years. So that's a selling price of $600,000 minus an appraised value on the date of death of $500,000, and that gives you a profit of $100,000 minus an exclusion of $250,000, which gives you no gain. You should be careful here though, because you won't be able to use this exclusion if you sold another primary residence within 2 years of selling the inherited primary residence. Also, the longer you keep the house, the greater the chance that you will have a taxable gain because the house will likely continue to increase in value. So as a strategy, you could hold on to the house and sell it when your profit is about to exceed the exclusion amount. Okay, now let's say that you didn't live in the home right away and you rented it out instead. When you decide to sell the house, you could buy another rental home so that you can defer the gain on the sale of the house that you inherited. If you don't want to buy another rental house, then you will have to go ahead and pay taxes on the capital gain. For 1 year or less before selling it, the capital gain will be short term and it's taxed the same as your regular income. If you keep the house for more than 1 year, the long-term capital gains tax rate would be 0%, 15%, or 20%, depending on your tax bracket. In order to avoid capital gains altogether, you could just sell the house immediately after you receive it. As I mentioned earlier, the cost or amount that was paid for the house would be the amount that the house was worth on the day the owner passed away. So let's use the same example of a house that was valued at $500,000 on the date that your last grandparent passed away. So we have a selling price of $500,000 minus an appraisal value on the date of death of $500,000. So there's no gain. Congress has actually considered changing the laws so that you won't be able to use the market value at the date of death. They would like for the original cost to be used instead. Let's hope that this doesn't happen. But at least for now, due to the current law, it is relatively rare for you to pay a lot of taxes on an inherited home. Understanding capital gains tax on an inherited primary residence can be a little confusing. So if you have any further questions or concerns, you can ask them in the comments section. I can't give you official tax or legal advice, so it's always a good idea to consult with your tax advisor for personalized advice. I hope you found this information helpful. We try to cover federal tax topics that will help you save on taxes. Please subscribe to catch the latest video. If the video on your screen right now can help you out, please take a look at that as well. All the best to you, and please be sure to join us on the next video.